I've talked to a lot of the major banks, a lot of the major asset managers that are so curious and interested in what we're building. And I would venture to say most of them are already starting to play in the space because of the efficiencies that just building on-chain can provide, especially when it comes to creating funds. Things like fund administration, like auditing, like accounting, it's made so much easier when it's on-chain. And you couple that with composability and you're able to just essentially create these super dynamic strategies in one click that would take a whole trading team and a whole auditing firm and a whole accounting firm to just manage off-chain. That's what got me so excited about Index Coop, honestly, because I see this world where everything's moving on-chain. Now you have the bigwigs talking about it, and the potential there is just super fascinating. So I'm not the only one. You'd probably ask everyone in structured products building on-chain. They'll tell you the same answer, but it really is an opportunity to kind of skate to where the puck is going, and I think it's really cool.
Welcome to the Edge Podcast. I'm DeFi Dad here with Nomadic from 4RC. Today's show spotlights the Index Co-op. In this episode, we talk about the future of structured on-chain products and how these products might onboard millions of new investors with simple tokens representing sectors, yield earning strategies, and leveraged exposure. But before we do, just a quick word from our sponsors who make the Edge Podcast possible. Discover MERLIN Chain, the cutting-edge Bitcoin Layer 2, trusted with over $2 billion in total value locked. MERLIN revolutionizes Bitcoin by unlocking its true potential with native L1 assets, lightning-fast transactions, and ultra-low fees on an EVM-compatible network. Elevate your Bitcoin experience with MERLIN Chain today at merlinchain.io. Power up your portfolio by borrowing, lending, and multiplying your favorite assets, made safe and easy by the industry-leading automation tools at SUMMER.FI. SUMMER.FI offers a curated DeFi experience to access the highest quality protocols and strategies. Discover new earn strategies for your portfolio in a user-friendly app designed to filter based on the tokens you hold, the networks you transact on, the protocols you trust, and the highest available yields. Learn more today at SUMMER.FI, the best place to borrow and earn in DeFi. Tired of hopping between tabs, searching for new tokens before the hype catches on? Try MATCHA.XYZ, the DEX aggregator from 0x. Matcha connects hundreds of DEXs so you can trade millions of tokens and find fresh new drops. Matcha works out the best route to save you money on every trade. Swaps are free and Matcha has everything you need to trade on-chain. Gasless swaps, limit orders, and cross-chain, all in one place. Search Trade Done at matcha.xyz. Catch the tide of the mainnet launch of Puffer Finance. Whether you're an Ethereum staker or an aspiring node operator, Puffer delivers the decentralization revolution with its cutting-edge technology. Start with just 2 ETH to unlock the potential of native liquid restaking and maximize your earnings. Join the movement now and anchor your stake at puffer.fi. All right, let's introduce Jordan, who leads partnerships at the Index Co-op. Jordan, welcome to the Edge Podcast. How are you doing?
Fantastic, fellas. Thanks for having me on.
So our goal here today is to do a deep dive on what we would call structured products on-chain. The Index Co-op has been a trailblazer in this space for years. If you are familiar with the DPI, the DeFi Pulse Index, this goes back to 2020. And this is one of the most popular products that I remember from the last cycle. It was a novel way to package different popular tokens into like a basket as one ERC20 token. And I know Nomadic and I were talking about, this was a token that we, commonly would refer to our friends last cycle who were just swapping tokens on chain because of the fact that it was just so simple to get exposure to all these different tokens. Fast forward to today, we want to cover all of the new indexes that have been created, some of the leverage tokens that are now becoming very popular, and then would also love to cover what's known as product revenue tokens, or PRTs. So Jordan, why don't you just kick off with a little bit more about, your background? You've got a history of working in traditional finance, so I think you'll be able to bridge the gap for us, translating all of this in DeFi to our friends in TradFi.
Yeah, I think ironically, your intro there around DeFi Pulse Index was how I found Index Cooperative. My background is in traditional finance. I worked at a name probably everyone knows, Morgan Stanley, for about 4.5 years leading into it. My job there as an advisor, both on the retail side and with equity compensation with certain companies that were going through IPO, was to take complex things and try to really just regurgitate it in a simplified manner for my clients, right? So it required me to learn about, unique technologies and kind of where the future of finance is going. And that led me to Ethereum back in 2018 as kind of an introduction for me. And over time, as I kept having to talk about it with clients and kept myself getting more interested, led me to find my way into the space. The first project I really intimately got involved with was a leverage perps platform, ironically, which is slightly different than what we do at Index Coop. But what I found to be so fascinating about how this space was created was that I just felt like a majority of the value went back to users. And in traditional finance, at least where I was at, there was always this kind of overhang in my head of like, man, it almost feels like oftentimes what we're doing is extracting rather than creating. And sometimes the users are the ones that didn't see the majority of that value. And with this particular project, I just felt like the way that the project was structured, the way that the token interacted with the community, it was this awesome synergy that got me so excited about the space. And so ultimately that led me to say, okay, how can I get more involved? And with that context, I was also looking to deploy a little bit of capital, and I came across the DeFi Pulse Index, as you guys did. Now, back in October of 2020, early 2021, it looked a lot different than it does today in terms of the constituents. That's a good thing, right? The product has evolved over time as the space has, and honestly, so has Index Coop. We sit here today, 2024, a few years later, and our product suite has evolved dramatically. Like, it started with just these sector indices, which we do have quite a few of now. We still maintain the DeFi Pulse Index. It's still probably the oldest and most well-known in our space. It captures the best and baddest that decentralized finance has to offer. It's names like Uniswap, Maker, Lido, etc. We've got a metaverse index now that really is looking at taking advantage of the emergence of entertainment and sports and the metaverse as everything kind of transitions on-chain. Last September, we launched the first ever cross-chain large cap index in partnership with 21 Co., which is a pretty well-known player, the parent company of 21 Shares, really trying to just simplify access to the broader crypto segment, right? Rather than looking at what's just on Ethereum or specific sectors there. Now we're able to capture the biggest and best projects across all of crypto, regardless of blockchain. And I felt that was a pretty awesome innovation and unique innovation for us at Index Coop as well, and to give folks broad exposure. So today we've got the sector suite I just explained. Again, very traditional. We're taking a theme, we're packaging it into a single ERC20 token. That goes a long way in terms of just allocating assets in the space. But to your point earlier, we also have a suite of leverage tokens that I'm really excited about. And this has probably been the most uptake from any of our products, which makes sense. As you guys know, like, majority of people on chain today are largely more, we'll call it like degen oriented. Like, we're looking for leverage, we're looking for returns, rather than your traditional investor who's potentially buying the S&P 500 off chain. So the leverage suite has been great. The cost to carry for fully collateralized leverage positions is significantly cheaper than funding rates on perps platforms. We're talking to the magnitude of, 3 figures, hundreds of percents APY at times. And people have really liked, for low leverage, being able to hold a position at a significantly less expensive interval over time. And also, liquidation protection as well. Everything with our leverage suite is built in at smart contract level to manage that leverage position, right? So if the price of ETH goes down significantly or up significantly, we're constantly rebalancing to make sure that you maintain that specific leverage position. So for today, we have, leverage suite just launched on Arbitrum. We've got Arb rewards there as well. We've got 3x and 2x and inverse on Arbitrum. We've got just 2x exposure for Bitcoin and ETH on mainnet. That was Bitcoin and ETH on Arbitrum as well. And that suite is going to continue to evolve and grow because, candidly, it's what people are asking for. We've also just built out a leverage UI that we're pretty excited about there. So leverage suite, big. Sector suite, big. We've got a suite of yield products that we're also quite excited about. Recently, we launched a high yield ETH index, which in about a month and a half of being in play is, I think, $15 or $16 million in assets today. And the goal there is, capturing ETH yield is challenging. And kind of the alpha moves from protocol to protocol across, as you guys know, I've seen you cover it on the pod. Like there's so many different ways to capture yield on top of the staking rate in the Ethereum ecosystem. So the high yield ETH index is just looking to abstract away all of that complexity, right? It's a buy and hold product that gives you access to the top high yield ETH positions. Today, you're going to find a lot of Pendle in there. You're going to find some Instadap, some Re7 wrapped ETH. And I think the beauty of a product like this is it will just continue to evolve over time, and you'll just hold the best and the biggest high yield ETH products. And we've got a few other ETH yield products there as well, including our interest compounding ETH. One that I'm super excited about, and then I'll kind of close the loop here, is we do have an upcoming stablecoin yield product that has partnership with two, we'll just say, very well-known players in this space. And what's most exciting to me is I feel like we haven't captured just a base rate in DeFi, like a base lending rate across stablecoins and DeFi, especially on Ethereum. There's not one place that people go to say, all right, this is what you can get, like a money market fund in particular in an off-chain world. And so we're kind of looking to try to tackle that and make it a good product for folks to have for dry powder, make it something that can just sit for the long term and capture just that base lending rate across DeFi, across the major platforms that you'd see. So yeah, sitting here today, we've got those 4 different sectors. We've got a multitude of products that can help. And ultimately what we try to do at Index Coop is just make it easy for you to navigate this. The risk and rewards across crypto can really be dynamic. I mean, there's a massive kind of bandwidth for you to work with, and Index Coop products just try to simplify that access and allow for you to make those wholesale changes and capture different risk reward profiles, but do it in one click rather than 15, 20, 25 transactions on a blockchain.
Jordan, I want to go back to just the leverage tokens for a second, because even last cycle, that was something that I think the market really wanted, but we didn't have, the emergence of all the L2s. So I think managing those positions for somebody like yourselves would have been difficult. I think it would have led to higher fees and funding rates, essentially, that the user is paying under the hood. And actually, an early representation of that was Tracer DAO, which I was quite enamored with at the time. And they had these leverage tokens, but ultimately, I don't think they could make it work, in part due to that almost like decay of your position. So you couldn't sit in it for long periods of time just due to like the cost of managing it. So my question is say I'm a user and I want to hop into a 2x position or a 3x position. What am I paying for that as a user under the hood in fees? And then just kind of want to reiterate too, I'm pretty sure these are non-liquidatable. Maybe kind of key in on that as well.
Yeah, I mean, the big thing with the leverage tokens, I think you touched on it well there, is there's a couple different areas of fees that you have to be aware of. There's a traditional, what we call cost to carry, which is essentially when you do lend, your position, there can be a cost there in terms of how much does it cost for you to maintain that position over time. And that cost to carry, can range anywhere depending on the usage on these lending platforms, but it's, relative to perps platforms, going to be significantly lower. The other piece that you had mentioned there, which is really just like how much price impact do you have, or what is like the decay that you'll see, because under the hood, we're rebalancing to maintain that proper leverage ratio. And every time you rebalance on mainnet in particular, those gas costs associated with it, that can add up a bit over time. There's no question that impacts every protocol that's building on mainnet, and we're no different in that aspect. And I think it leads to say that, the behavior of someone holding a leverage token, obviously it's a trading vehicle. You can dice it up however you want, but the costs still add up, and there's potential that, that position will decay over time, especially on mainnet. But to your point, I think this is where a lot of teams are going, including ourselves, why we just recently launched on Arbitrum, why we're really pushing hard to get on base as well. Some of those issues are at least mitigated by being on an L2, because the cost to manage those rebalances on the back end is significantly lower. There still will be a cost to carry based on just how the lending platforms work. But the rebalancing can be significantly easier, significantly cheaper, and that, in turn can allow for you over time to hold the position longer if you want. I mean, still, the reality is if I have 100% on day one and we go down 75%, if it goes up 75% again the next day, right, you're still not net positive. That's just the way that math works, unfortunately. And that applies across the board. So being cautious with leverage is certainly important. But, The goal for us was to provide an alternative to perps that's just lower costs and that provides a better outcome for folks if they want to use low leverage. And candidly, I think in most environments, we're able to do that with the leverage suite. And to your point, again, it's all about reducing costs and reducing friction for users. If we can continue to build on the back end ways to automate leverage so that you're not worrying about having that position liquidated like we have today, but also improve our tech stack, whereby it's just cheaper to hold that position for longer periods of time and get it closer to the intended benefit here, which is simply 2x or 3x leverage on that position, then that's what we and other structured product providers will continue to try to do. I'm excited about where the space is going. I feel like a lot of teams have picked up steam, especially on the fully collateralized side. There was a big push last year for the perps platforms. They kind of became the talk of the town. It seems as though fully collateralized, leverage positions are at the very least, kind of seeing their day, especially for these low leverage positions.
If I'm holding a leverage token and the price is going down, can you dumb down for us, like what's happening under the hood? I'm holding that token and let's say it's like the 2x ETH token. Can you just explain like the mechanism, like what's the automation that's happening there under the hood?
Yeah, I think it's a great question. At the most simplest form, what the protocol is trying to do is maintain a certain leverage ratio. So if you deposit ETH, you pull out that USDC as collateral, we buy back more ETH. What it's trying to do, say it's a 2x token, is maintain 2 times the amount of ETH as you add going into it, thus giving you twice the amount of exposure. If the price of ETH drops significantly, that collateral that you've pulled out against it, in this case USDC, isn't changing. So there's potential here that if it continues to drop, that you have to liquidate some of that USDC to essentially make that lending platform whole. What the protocol is essentially doing is just automating that for you. So under the hood, it's kind of piecemealing together these liquidations that try to keep you within, we call it just a range-bound methodology. Tries to keep you within like a 1.8 to 2.2 kind of times leverage at any given point, so that, again, that the end product here is giving you that 2x leverage. So you just have to be mindful for big moves if you're not doing this, via a vehicle like this, because again, this happens autonomously under the hood for you. If you just do this leverage position by yourself and the price caters, there is a potential that you're not going to be watching and that you'll have to just automatically be liquidated and you lose principal there. So I think that's a huge benefit to our 2x tokens. I think it is a unique differentiator for us as well. And it's been tried and true. We've had these out since 2021, mid 2021. And to the best of my knowledge, no one's ever been liquidated. So that's a good thing to talk about, I think, on a podcast. And yeah, it's kind of complex, to be honest. But I think they do a pretty good job of capturing what they're trying to do.
One of the reasons that the leverage tokens have always appealed to me is that one, you called out that the effective funding rate that you're paying, it nets out to being less than what you would be paying if you were opening a position on like lots of the popular decentralized perps exchanges. So there's one reason there. The other one is we just called out, there's automating my ability to avoid liquidation as long as everything's working as intended. The one final point I wanted to make here, though, is if I'm holding this tokenized leverage, are you aware of, is there any support yet for like collateralizing that? Because I'm imagining at some point, this is just another benefit that's going to draw in more users, assuming that they're not a United States citizen, that are prohibited from using these products. Those folks, though, are going to be happy to hold that levered position. And let's say we're in an uptrend and ETH is going up with 2x or 3x leverage. Like that can be really powerful now to be able to borrow against that. Not recommending folks do that. Again, there's a lot of added risk to that. But, this is part of DeFi. It's the freedom to do what you want. And I know that there's folks with that risk appetite to borrow against leverage tokens.
I think broadly with all of our products, we're gunning to add as much utility as possible. And whether someone wants to borrow against it or write an options contract on it or provide liquidity for it, the reality is I think that is a superpower of DeFi. this composability, the money Legos, we've all talked about it. With a product like the leverage suite, obviously every platform is different in terms of what they will list and why. It's been challenging to get in the door and have those conversations, but again, broadly speaking, it should be a goal of every structured product on chain to have the ability to pull, to use as collateral on lending platforms. Because to your point, especially if you hold this position, which I'm not recommending you do, but for long periods of time, liquidating the token is it's a tax event, and ideally you're able to kind of borrow against it and do things with it. So utility, always working on that, always trying to provide more utility with our tokens. I think every project in the space is, but I would say nothing coming down the pipeline like super quick.
Jordan, I want to touch on DPI again. As DeFi Dad mentioned, that's something like I held a long time ago and admittedly had fallen off a bit on like what's in that basket of DPI, but I think I was like pleasantly surprised and impressed just to see what's in there right now. And I feel like it's like a good representation of DeFi blue chips that I would want to own, and some I do own personally already. But I guess my question is just like, maybe speak to its evolution over time, and what is like the process for rebalancing those assets within the DPI? Like, how does that work?
DPI has evolved a lot. And I remember kind of the tail end of the beginning of the whole downfall of the space in 2022, there was a boatload of pressure from the community to include names like Terra Luna and some others that were at Olympus, and some of these names that were kind of becoming the DeFi 2.0, for lack of a better term, talk track, right? And I think the cool thing about index tokens is the way that they're constructed is pretty strict. Like, you have a set methodology. That methodology has been vetted. That methodology is being used to say what is or isn't included in the criteria of said token. And in the case of DPI, I think what we did a really good job of in the early days of doing is creating a methodology that does kind of weed out just brand new entrants, ones that are potentially dangerous, but we don't know it yet. So you saw a lot of DeFi 1.0 tokens just continue to stay put. Now here we are, 2 years later, you've got names again like Uniswap, we've got Maker, Lido, Aave, Synthetics, Pendle had just made the list. So they're now about 5% of the index. It really is a good representation of the best in DeFi. And if you're someone that's new to this space, like we were, back in the day when we first were introduced to this product, and you're starting to play around in the space and you're seeing some of these names that you're swapping on or providing liquidity to, I think it's a great tool still today. Even in its old nascent form, it's rare to see a product from 2021 actually still be here, but it did a good job of kind of making it through what was a chaotic time in DeFi. And now here we are on the other end with, I think, a pretty awesome list of names under the hood. And the beauty of it is that's going to change in 2 years. That'll change in 4 years, 6 years, 8 years. But you hold the token, that kind of rebalancing happens under the hood. To your second question about how rebalancing occurs, at each interval, in this case it's quarterly with the DeFi Pulse Index, we're essentially taking a snapshot based on that methodology and saying, all right, what should or shouldn't be included? And this is done via the Index Coop DAO, right? That's part of the reason why we exist, to manage these products. Based on that, we're looking at different changes that have made based on the methodology of the product. And we're going out actually facilitating the swaps on Uniswap in this case, to either pull new assets in or reduce, percentages in the old assets. So that is done under the hood. That's done via the Index Coop DAO. Again, nothing changes from the standpoint of the token holder. And it's just, again, looking at this methodology. And based on that methodology, we've been mandated to say what is or isn't included, and then executing those rebalances via DeFi rails. I think one cool piece of tech that you guys might be interested in is, obviously for lower liquid tokens, like the ones kind of lower on the totem pole, lower market cap, just less volume, going out and executing swaps on a quarterly basis could potentially on mainnet be costly, right? Because you have gas fees and potential slippage and whatnot from actually managing that position or going out and pulling from Uniswap. Recently, we added what we call auction-based rebalancing to the list. And what this allows for us to do is actually, rather than having to go out and take liquidity from decentralized exchanges, this one allows us to make liquidity essentially, where anyone can come in, connect to that auction-based rebalancing module. We put out what we're trying to do, and they can pull and source liquidity from virtually anywhere. It could be centralized exchanges, could be OTC, doesn't matter. They're coming to us and saying, I'm going to execute this trade on your behalf. In principle, if we have a bunch of people working on that rebalance, we should have a much more cost-effective rebalance. The issue today is there is some legacy tech debt here, like the DeFi Pulse Index is technically on set protocol. All of the auction-based rebalancing is on index protocol. We are going to migrate at some point so that we can participate with the auction-based rebalancing. But I think that's a huge step, especially for newer products, and just creating more cost-effective rebalances. And honestly, it had to happen. I think everyone who battles this in structured products in this world, rebalancing is something that is a challenge for most teams. And the ones that can do it the most cost-effective way, it just creates a better outcome for the user. So naturally, we're putting a lot of resources towards making that better.
Before we get back to the show, just a quick thanks to our sponsor at Mantle Network, the layer 2 that pioneered the 5th largest LST with 1.6 billion TVL called MATCH. Since July 1st, Mantle is running a 100-day airdrop campaign called Metamorphosis to distribute a new governance token for the Mantle liquid staking protocol called Cook. The community can earn points for Cook called Powder by holding METH in Metamorphosis and simultaneously enjoying other yield and reward opportunities in the Mantle ecosystem. Users can also earn Powder by staking MNT in the Mantle Rewards Station. For more details, go to the Mantle blog at mantle.xyz/blog and follow the 0xMantle handle on Twitter for more updates. Jordan, what can you tell us about this RWA index? And maybe you can also touch on, what have you learned from the other indexes over the last few years? I want to call out, there are a number of indexes there that, look pretty dead to me. There's not a whole lot of interest in some of them. I'm assuming you guys have taken some lessons there, and, the RWA represents, the most strategic thinking.
Okay, so, thinking through the RWA index, one of the biggest learnings that we had as an organization over the last 2 years was that it's really hard to beat the cold start problem, right? You can't launch products that have no TVL, that have no traction, that have no excitement around them. So what we introduced for all new product launches, in particular the index side, is this concept of a pre-sale. And this opens the door to product revenue tokens, which I'm really excited to talk about today. But essentially what the pre-sale is a 30-day window where if we don't hit a certain amount of deposits in that particular token, we're just not going to launch it. Because the reality is we've proven that demand isn't there, and it's likely that that product's not going to succeed. And this matters a lot, not only with just the success of the product in DeFi, but also for integrations, right? No exchange or CeFi platform is going to list a product that has no TVL, that has no volume. You guys kind of see how this flywheel works. So the introduction of product revenue tokens was really exciting for us because what the PRTs essentially do is take all of the product revenue, and instead of them all coming to the Index Coop DAO, now they're going into ERC20 tokens that are called product revenue tokens. So for the case of the RWA index, we were giving away 15% of all revenue indefinitely via these product revenue tokens if you came in and provided that pre-sale capital. In this instance, it didn't work out, right? Not enough people were interested in the theme. Perhaps it's just too early. We've speculated on why as a group, but it doesn't matter. Demand wasn't there. In the case of our high yield ETH index, which was the first product that we used PRTs with, it did. We had, I think, 5 million in TVL going into the product's launch, which was a brand new thing for us. And what I think is awesome about PRTs is it kind of takes, it's like points 2.0. And what I mean by that is in the points structure, you have these activities that you're incentivizing. You have this token generation event, and then it's a governance token, and likely, they're selling that token and they're just kind of moving on. With PRTs, you have an ownership stake in the success of the product. It's like if in 1980, you were a part of the very first S&P 500 index, and because they couldn't bootstrap liquidity and it wasn't a thing even then, they said, all right, we'll give you 2% of revenue indefinitely via these tokens or whatever. That's worth a lot today. That the revenue flowing through that is significant. that's essentially what we're doing. But what's super fascinating about it is everyone who holds a PRT, so everyone who participated in that pre-sale, that now pro rata was given, in the case of HYE, so 30% of product revenue indefinitely. They have an incentive to talk about the product. The only way that that PRT becomes valuable for them is if the product succeeds, right? So the incentive is so aligned with the success of that product. And in some ways, it creates like this decentralized cabal of just product advocates that in theory should be out there saying like, hey, HYE is an absolute banger. You should buy this thing because it benefits them. And what I think is also super interesting about PRTs is it's not just about the revenue that's going to flow through them. They're ERC20 tokens. They alone will create the market over time. Like there's potential here that, and we're kind of seeing this play out in real time right now since HYE launch, that with PRTs, folks could sell them. And if somebody comes in and says, you know what, I believe in the high yield ETH index, I think the space is going to be huge in 10 years. It's getting X revenue today because there's almost 20 million in assets, but I think it's going to be at 30, 40, 50 time multiples of that. Whatever the market decides, it really doesn't matter to us, but they have the ability to then sell that. And we have a new product advocate that's saying, hey, I think this is a great product, right? So it creates this really interesting flywheel. So yeah, we introduced pre-sales because we thought PRTs was a good way to align early depositors. And the last thing I'll say on that end, really there's two more things about PRTs. One is it's not just pre-sale activities that we care about, right? I mean, solving the cold start problem is very important for obvious reasons, but there's also the same issue with distribution partners. It's like they look at just traditional revenue share and say, it's just not enough. What can I do to incentivize a distribution partner to say, hey, I want to take a risk on a smaller token that's brand new? There's no better way to do it than through PRTs. And so for us, it can create this nice flywheel where we're able to actually negotiate deals with distribution partners. They promote the product, they benefit from the success of the product, and so on. And that also applies to liquidity providers. Like really important for a lot of our products to have ample secondary market liquidity, especially if it's a mainnet product, like our high yield ETH index captures yields on mainnet. But if we want that thing to be on Arbitrum like it is today, or on Optimism, or on Base, you've got to be able to have sufficient secondary markets. PRTs, again, are another incentive that can bootstrap those markets. So from the DAO's perspective, people always ask, like, doesn't this fragment liquidity from the index token? The short answer is no. One, we've always had a revenue share in place, whether it's with the methodologists, whether it's with an infrastructure partner, whatever. Still, revenue is coming to the DAO. We own, say, 70% of HYE's PRTs, similar to what it was like before. I think the fundamental difference here is, like, if you own 100% of revenue on a product that has no TVL, who the hell cares? If we own 70% of revenue on a product that's succeeding, and you have this kind of group of advocates out there, that's a way better outcome from the organization. And, in time, we'll be able to use that revenue and, potentially if the community decides to turn on a fee switch or whatever it might be in the future, I'm not speculating, it's all going to be driven by the DAO, but, that can flow through. And the other bit is we're not having to use just index to incentivize these activities. Every product that comes out, now we have a new mechanism to incentivize the key activities that allow for it to succeed. Every single one, right? So instead of having to continue to either inflate index or, give away all that the treasury has and kind of eat away at the runway, you have this mechanism for bootstrapping products that is completely unique to that product. So I think it's awesome. We've had good feedback for the most part from folks trying to optimize how PRT holders can make this product a success. I think it's the next step for Index Coop. But it's a newer kind of incentive mechanism that, we're pretty stoked about.
Jordan, PRTs sound really interesting and novel to me. And I think I just want to reiterate, I think something that Index is doing with, if you don't get that pre-sale, buy-in, you kind of abandon it. I think that's really being honest with yourselves. And I think this PRT mechanism is a really interesting bootstrapping mechanism, like you pointed out. So I think just to reiterate a couple other things, I think you mentioned that Index Co-op holds 70% of the PRTs, and then you issue the other 30% to users or other participants other participants that you want to kind of incentivize to bootstrap that TVL. I think it's really cool. And I think, like, I guess one question to you, do you think you would ever play with that lever and say, hey, you know what? We actually see it more beneficial for Index Coop to take 50% of the PRTs. And we think getting that TVL and getting people, you know, maybe more money flowing into this new product is more impactful. And we're going to go 50-50, or are you ever going to like play with that kind of fee structure, do you think?
Yeah, it's a great question. And absolutely is the short answer. We're always looking at how to improve it. I think we were very generous with HYE, essentially just incentivizing one behavior. That behavior was deposit and hold. That behavior was trying to solve the cold start problem. As I mentioned earlier, there's a lot of behaviors to incentivize, whether it's liquidity, distribution. That means some key things that'll help the product succeed. And the mechanisms that we use, like we changed it a fair bit for the real world asset index. We were, you know, again, in the forum post, we expressed that now a smaller chunk is going to go towards the pre-sale deposit. Now we're going to incentivize LP providers, distribution partners. The organization really just wants assets to come through the product. And, you know, there is a scenario where over time, like we're incentivizing more activities at later dates for HYE with the 70% that the DAO holds. That's really up to the DAO to kind of figure out. But without question, like what we found is that at least in our early stages here, PRTs can be used to incentivize long behavior. The most interesting part for me was when we actually went live with HYE. The amount of people that sold HYE and the PRTs, or both, one or the other, was significantly less than we expected, right? In a traditional TGE event, you have folks getting, yeah, at least we've seen it both ways, but oftentimes they will just abandon the protocol, they'll sell the token, and they're moving on to the next one. We didn't see that at all. And I think that's really interesting in that, I think to my point earlier, it's like the product needs to succeed for these things to be successful. So perhaps there's more incentive for you to stick around. But from the organization's perspective, like we're going to continue to evolve. We could give out significantly more of these on the next one, continue to kind of learn what is working, what isn't working. We can't really determine based on the real world asset index how much of an impact dropping it by 15% in the pre-sale side had on people actually depositing assets. I would imagine it's probably more about the theme. But no, it's a great question, and we'll continue to kind of evolve our thinking there and just learn from the data and move forward.
Just to, so it's clear in my mind, if somebody buys into this PRT, they're entitled to the yield or the revenues from that new index into eternity, or as long as that product stays going, right? And they can sell that position to somebody else if they want?
That's correct. Yeah.
Jordan, with the Bitcoin and Ethereum ETFs live, I'm curious where things like Index Coop fit into this on-chain structured product world. And maybe like, what does the future of structured products on-chain look like to you?
Yeah, ironically, with the Bitcoin and ETH ETF, I think they're so boring, and I'm sure you guys do too. Like we're taking an asset that's on-chain, we're taking away all of its superpowers, we're packaging it, and we're just sending it out into the real world, I guess you could call it. That's great for education. I view it as like a Trojan horse of just educating people on our space, but it eliminates all utility. It's virtually pointless. When Larry Fink and others in traditional finance talk about kind of that step after ETFs being tokenization, that's way more interesting for us. And it's kind of a natural progression when people look at ETFs, what comes next. Now, there's two ways to look at that. There's taking a finished product like a fund or something on-chain and tokenizing that and putting it on-chain. Sorry, something off-chain, moving on-chain. That's great. I mean, it's helpful. You have 24/7, 365 markets. You're able to, potentially provide liquidity. You're able to borrow and lend against it. I think it helps create liquidity for otherwise super illiquid assets, and that's a major benefit to this space. But what excites me even more is kind of the next step. It's if we could tokenize and all the originations of the assets, so the stocks and the bonds and the treasury bills, all of that is on-chain. You're able to, in such a dramatic way, like reduce the costs for building these strategies, like just dramatically increase efficiencies for issuers who are building funds and for participants who are wanting to create strategies and just automate their financial life. And when I hear Larry Fink and others talk about the future being tokenization, like that, to me, is where it goes, because we all know that organizations love to make money. They love to offer a differentiated product. when you have more assets on chain that are tokenized, you're able to do so much more, like having specific niche of commercial real estate in some particular geography. Like the way I view it is the traditional 60/40 portfolio is going to look so much different in 5 years. And the efficiencies for actually issuing and building these types of strategies will be just massively more impressive when everything is on chain because of the programmability of smart contracts and just the way that the system runs. Index Coop, our general thesis is that all assets that can be tokenized will be, and somebody's got to manage all of that. Like someone has to take 10, 15, 20 transactions and turn it into one over and over again so that you can simplify that on-chain life. We want to do that for users. And so the way I see kind of Index Coop playing out, and this is my personal opinion, we'll see what the DAO decides to do, but is today we're all crypto. Today, everything that we do is originated on chain. So it creates a really good environment for creating these structured products. As more assets move on chain, as more origination is done on chain, it doesn't matter what the asset pool is. We'll be building products around it. We'll be just, again, taking unique strategies and simplifying them for folks. And I think that's super powerful. Candidly, I've been in this role for a few years now. I've talked to a lot of the major banks, a lot of the major asset managers that are so curious and interested in what we're building. And I would venture to say most of them are already starting to play in this space because of the efficiencies that just building on chain can provide, especially when it comes to creating funds. Things like fund administration, like auditing, like accounting, it's made so much easier when it's on chain. And you couple that with composability and you're able to just essentially create these super dynamic strategies in one click that would take a whole trading team and a whole auditing firm and a whole accounting firm to just manage off chain. That's what got me so excited about Index Coop, honestly, because I see this world where everything's moving on chain. Now you have the bigwigs talking about it. And the potential there is just super fascinating. So I'm not the only one. You'd probably ask everyone in structured products building on chain. They'll tell you the same answer. But it really is an opportunity to kind of skate to where the puck is going. And I think it's really cool.
Jordan, when I hear that answer, all the efficiencies gained from being fully on chain, you're maybe not needing a whole admin team. It just feels like it could cut the head count of an operation down dramatically. And then I look at something like a Bitwise, who huge fan. I think they're amazing stewards of our industry. But they are kind of like that on-chain parallel of Index Co-op in some respects with some of their index products. So I guess my question to you is like, what would it take for someone like a Bitwise to do like an Index Co-op index at some point? Or is that something that would never happen? Is that something that could happen? It seems to me like there's a lot of like financial incentives for them to do that if they could get comfortable with it. But curious what you think about that.
Bitwise has taken the opposite approach as Index Coop. Bitwise has said, there's a new asset class in crypto. Crypto is fascinating. I know that everyone off-chain, from financial advisors to fund managers, are looking for ways to differentiate their offerings. What I'm going to do is take that new asset class, I'm going to package it in something that's super familiar for everyone, regardless of operational efficiencies, and make this asset class accessible to the masses. We need that in this space. We genuinely do. Well, I think the scenario that I'm playing out is the next phase. It's, okay, we know that crypto as an asset class is here to stay, but we also know that blockchain as a function of creating efficiencies can help the traditional infrastructure. And we're also all in consensus that, yes, assets are moving on chain. I think that's when groups like Bitwise and BlackRock and others get involved, because to me, this is kind of the next iteration of fund management, if I'm being completely candid. And we're just not there yet because not enough assets have originated on chain. But I mean, to say that, Bitwise or anyone else couldn't come in and try to create a protocol that abstracts away all the complexity on chain and offers it in a token, I mean, I'd be lying. I know that plenty of teams are working on this now. I think the reality is they're going where the money is. And right now it still is in traditional ways, right? Packaging that in the fund and navigating the traditional setting. That could change in a year, could change in 2. We'll see. But I think just generally from a technological perspective, there are plenty of benefits, but the reality is none of that matters if the people aren't there to buy it. And so we're kind of battling from the opposite end, right? We took a technological forward approach. We're all protocol driven, smart contract driven. but we have a very unique user base to work with. Granted, it is global, and I think there's plenty of benefits there. It does take just a polar opposite approach. And I'm sure over time, groups like Index Coop and Bitwise and 21 Shares and BlackRock, for gosh sake, will kind of meet somewhere in the middle as it just becomes meshed between on-chain versus off-chain and real-world assets versus crypto. Those lines are certainly blurring, and I don't see that kind of slowing down anytime soon.
Teller is a decentralized protocol that enables anyone to borrow or lend using any Ethereum asset. You can think of a Teller loan as a DeFi cash advance, one where you can use any of your favorite ERC20 tokens as collateral to get an instant USDC loan. Discover the power of a DeFi cash advance today at Teller.org.
At Moonbeam, we're building a world where the wonders of decentralized technology are accessible to everyone. We're advancing Web3 integration through product enhancements, funding for innovation, and investment in our partner ecosystem. Our product roadmap includes ZK initiatives, tokenomics updates, and 8x throughput. Our $10 million innovation fund invests in startups that deliver cutting-edge solutions for RWAs and Web3 gaming, and our partner ecosystem continues to grow through grants and incentives. Moonbeams is delivering frictionless user and builder experiences to create the future of the internet on-chain. Join us by participating in the Moonrise campaign today.
We're almost near the end here, but I want to do a quick kind of check-in on the state of the Index Co-op DAO. I've been in DAOs for feels like forever now, and there's just such a varying degree of like operational efficiency across all of them. So just kind of like, want to get take the temperature on how's it going in the DAO? Like, yeah, just kind of the state of efficiency, like, and maybe just like what you've seen in that like evolution of that DAO over past however many years it's been.
Man, I'll tell you, it is coming from a firm like Morgan Stanley. When I first showed up in the DAO in 2021, early 2022, your point about operational efficiency, my mind was kind of blown in terms of how things function. Like the concept of a DAO is so powerful. Like you're taking experts or not even, it's people from all over the world. We're packaging them together and we're trying to create something that we're all passionate about. But in the early days, it really was so muddled. There were folks coming in from all over that were potentially not providing value, but getting paid to do it. And it created this environment where we just weren't moving very fast or very far. And you have to think of it like a business, right? The ability to actually pay these people and to have a runway that passed through an inevitable bear market, which we saw shortly after I joined. In fact, right after I joined, pretty much everything in the world blew up. My wife was super stoked about that. But the evolution's been incredible. Like the DAO over time has decided that, we're going to try to streamline things. We're going to mandate people to make decisions on behalf of the DAO rather than making this consensus approach. We voted in a couple different governance structures that did allow for people to do that. And it's created an environment now where we're just moving so much faster than we were before. Where this goes in a year, I genuinely don't know. I think some of it's driven by regulatory clarity and change that we'll see on that side. Some of it's driven by operational efficiencies and tooling that's gotten so much better over the last 2 years. The DAO itself, we'll kind of see where this thing goes, but I'll be candid in that it's changed a lot. I think when I first got here, there were almost 100 contributors to the DAO. And today we sit at somewhere around 15 to 18, somewhere in that range. So significantly less than before, but arguably more work is getting done. So yeah, again, this combination, I think that it's fascinating. In the early days of the DAO, like, is this a new beast? Like, how do you wrangle this beast? It's never been done before and nobody's tried to do it before. So we're, as with every other DAO, like flowing through this process of understanding how to create a decentralized, efficient beast and do it in a way that's compliant with everyone. It certainly has been, it's been a fun little challenge for all of us.
Guys, I think this is a good place for us to start to wrap up. This has been such a refreshing conversation. I've been an investor in SET protocol going back to like 2020, 2021. There's kind of like an inherited relationship / like membership in the Index Co-op DAO, and still consider myself a member of it today. Just sometimes I'm more active, sometimes I'm less active. So It's a real joy to get to talk with you, Jordan. I think what you've brought to the table here, it really represents the best of the DeFi space, looking to go mainstream, onboard hundreds of millions, if not billions eventually. And meanwhile, sort of challenge the status quo of TradFi. So yeah, just a really enjoyable conversation. I want to remind our listeners that they should learn more by going to it's indexcoop.com. So that's the website. They should follow Index Coop on Twitter. They should follow Jordan Tonani, if I'm saying your last name correctly. And you can find that all in our show notes. And then actually I want to close out with a question about pronunciation. There's a lot of controversy around how you pronounce Index Coop or Index Coop. So if you can settle that debate for us, how is that properly pronounced? And then if you can just close this out with is there any other major milestone we should look forward to in the coming months or the next year for Index Coop?
Yeah, this might be the biggest controversy going on in crypto Twitter right now. There's nothing else going on in the world. To be candid with you, we've gone back and forth as an internal group on Coop versus co-op. Cooperative is technically the full name, but we are owls, and that's a Coop. So I say Index Coop. I think most people at Index Coop say Index Coop, but there is no judgment. Use whatever name that you want. Cooperative, co-op, up to you. At some point, maybe we'll put out a mandate saying, hey, everyone refer to us as Index Coop, but for today, we're all good. But what I'm most excited about from an organization perspective is probably that stablecoin yield index that we have coming up. I think that it's such a missing piece to the space at large, and it'll adopt both TradFi and DeFi native people into it. So that's exciting times. Just generally speaking, I think the ETH ETFs do a great job for promoting the space. I think it's probably the best thing that has happened to us, and we're all not as excited about it as we should be. So I just saw an article from BlackRock explaining why Ethereum is great. That's pretty powerful. So I expect a pretty exciting next 6 or so months. But yeah, guys, I appreciate you having us on. I love the pod. Big fans of what you guys do, and it's been fun.
Thanks everyone for tuning in. If you're a talented founder or developer, please consider reaching out to our team at fourthrevolution.capital. And for future episodes of the Edge podcast, please check out our link tree at edge_pod.